Alrighty. I have Greg Kanarian joining me today from Natixis. He is the investment strategist, I should say, at Natixis, and he is responsible for the direct indexing strategy, which we're going to be talking about today. Greg, thanks for joining me today.
Thank you for having me.
I wanted to just jump right in. And before we hopped on this call, really the summary of today is, explaining to retail investors or your everyday people what the strategy of direct indexing is. So I joked with Greg saying, hey, can we explain this to folks like they're 5 years old and go, hey, that kind of maybe a light bulb comes on and that makes sense, because I think it's a very cool strategy that could make sense for some people. So I guess just diving right in, my first question, what is direct indexing? And give me the history of it, because as I know, over the last several years, this hasn't just been around for the last couple of years, although business has increased in this particular area. And I think that by the end of the call, people will see why. But give us the history on direct indexing, how long ago it started, and ultimately, what is it? And obviously, we'll get into the weeds with some other things.
Sure. Yeah, happy to. So direct indexing is an equity strategy. So we buy stocks, and the idea is to build a portfolio that matches the performance of an index, a pre-selected index. Usually it's the S&P 500. So match the performance on a pre-tax basis, but outperform on an after-tax basis. So a lot of the times when we're investing money, we're just focused on what's the performance, how have you done relative to the benchmark. But here we're focused on how do you do relative to the benchmark, but also what do you get to keep after all is said and done when you have to pay taxes on capital gains, taxes on interest, taxes on dividends. So the direct indexing strategies are built to outperform on an after-tax basis. And really, there are two ways that it's done. One is through tax loss harvesting, which we can get into. But basically, tax loss harvesting is selling a stock when it's down and replacing it with another security. By selling a stock when it's down, you get to book that loss for tax purposes. Consider it a tax write-off that the investor or taxpayer can use to their benefit, and that has a value. And then the other is deferring gains to the future. So the idea there is, if you have a stock that's at a short-term capital gain, something you've held for less than a year, if you sell that at a gain, you're going to pay tax rates that is commensurate with your wages, with your ordinary income. If you wait till it's over a year and sell it, you benefit from the lower capital gains rate. So by waiting a day for a stock to go from short-term to long-term, you save depending on the tax bracket, up to 20% in taxes just by waiting one day. So it's really focusing on these kind of two main areas of tax efficiency that exist in the tax code and using that to your advantage. But backing up, we're just trying to match the performance of an index. And so the S&P 500, as you know, has done really well over the last decade. Over the long term, it's kind of the benchmark that every active manager is trying to beat. So the idea is that, hey, let's not try to beat the benchmark. Let's match the benchmark, which if you look over the past 10 years, the S&P's annualized 12%. And that's plenty for investors to meet their long-term goals, as you know. But that's really focused on the back end and outperform on an after-tax basis. And so kind of the history of these strategies, they have existed for 30 plus years, but really they were focused on high net worth and institutional clients, because we're buying individual stocks. Commissions used to be really expensive, but now that commissions are less expensive, we have technology to allow us to trade more frequently for less cost, and also to build a portfolio of stocks in an efficient manner. And part of this whole thing is to replicate the performance of the S&P 500. You don't need to own all 500 stocks. An index fund or an index ETF will do that, but we don't want to own all 500 stocks, because if we're going to sell a loser, we got to replace it with something else. We can't buy the same stock back. Otherwise, we're going to hit this wash sale issue. So we want to be able to buy another stock that we don't already own. So we own a subset of securities in our portfolios, or in direct indexing portfolios in general. So you don't need to own all 500 stocks to have performance that looks a lot like the index. And I think that's been clear in the past couple of years. If you just look at the Magnificent Seven stocks, for example, just those 7 stocks have driven most of the performance of the index. So as long as you had those plus some others, you've tracked the index pretty well.
Yeah, no, I think I think what's the percentages now of the Mag 7? It seems like the market cap of the S&P has gotten larger and larger. But ultimately, one of the questions I get a lot when I'm talking about the strategy is, well, like, most people have heard about indexing.
Yep.
But direct indexing, the differences between the two, like, why would, hey, I'm tracking the S&P 500, I have a low expense in my index fund that I personally own. Like, why would I consider something like this?
Right. Yeah. So the direct part of direct indexing means that you own stocks outright. So you have an account, and instead of buying one SPY ETF, for example, to get exposure to all 500 stocks in one line item, you're going to own individual stocks in your account, all members of the S&P 500. And what that allows us to do is that when one of those individual stocks is down, let's say there's some market volatility, you bought it at 100 and now it's at 90, you can sell that stock at a loss. And you take that $10 loss and bank that to use against other gains in your portfolio. If you don't have other gains, you can use that tax write-off in the future to offset gains that you might recognize 2, 3, 10 years down the road. So that loss is available to the client to use on their own tax return. If there's the same stock that's down within the ETF, that loss for that individual stock is going to be reflected in the performance of the ETF, but the client doesn't get to harvest it themselves. They don't get the benefit of that volatility in selling this thing to capture the economic value of these losses. And if you just kind of think about it, if you've got a 10 stock that you made $10 on, and you have a stock that you lost $10 on, those two can offset each other. But if you just have a stock that was up $10 and you don't have that loss to offset, you're paying capital gains tax on that $10. So by having this loss banked, you can offset, and at the end of the day, the performance is still going to match the index like it would in an ETF or index fund. So the pre-tax returns are going to be in line. It's just throughout the year we have taken lemons that were given to us by the market and turned it into lemonade, turned that volatility into something valuable for the client in terms of this kind of tax write-off or tax benefit.
I like that. I like that analogy, taking lemons into lemonade.
Yeah.
That kind of goes hand in hand to my next question. What are some of the most common cases for direct indexing? Where do you see people implementing this within their portfolio?
Yeah, so first of all, this is predominantly a strategy used for taxable investors. You could use it, and I can give you an example of an application. You could use it in a retirement account, but you're going to use it in accounts that are going to be taxed. So first is, instead of using an index mutual fund or ETF for clients that are in certain tax brackets, and typically we're talking like the 32% tax bracket or higher is where this really makes sense. Use it as a core equity strategy. So have it as your core large cap holding, and you're going to perform in line with the index, but at the end of the year, you're going to have some losses that have been generated, again, that you can use to offset other gains. Maybe you had a great stock pick somewhere else, and you can mitigate some of that tax liability there. So that's one. Another is as an account transition tool. So for example, maybe you have a large cap value manager that has 50 stocks. You're underwhelmed with their performance. You don't want to have them manage your money anymore. Now you have 50 stocks that you don't have managed by a professional. You fired that manager. Well, you can bring those to a direct indexing account, and because the universe is 500 stocks that they would select from within the S&P 500, that manager will likely take those stocks in kind, not force you to sell them, not force you to have a taxable event. So it can be used as a sponge to sop up securities that maybe an investor has collected over time, or they've, like I said, has fired another manager.
Sure. That's where it's super interesting for those highly concentrated positions, right? Somebody works somewhere at a company for 10, 15, maybe their entire career. They've accumulated a lot of company stock, and they're sitting on a bunch of unrealized gains. And correct me if I'm wrong, but you can actually say, hey, at Natixis is say, hey, this client, Mr. Client or Mrs. Client, is comfortable accruing X amount of taxes in terms of a gain, right? So where, let's say, hypothetically, they move over a large concentrated position, but they're not willing and able to want to take on more than $50,000 in gains from that particular position. We can go in there and say, hey, Mr. Client here has stated that they don't want to take any more gains than $50,000 this year from this position, and you can implement into the strategy, right?
That's correct. So, another common way is when I talked about an account transition, that would be kind of like a diversified portfolio. But oftentimes, advisors have clients that have concentrated or low basis stock positions in a stock. And it's a good thing and a bad thing. So it's a good thing because likely it's a low basis stock because the security has done really well. So the client has made a lot of money in it. But it's a bad thing because the client gets emotionally attached to that security, and they have a tough time deciding on when they want to de-risk their portfolio or diversify. So advisors are always kind of trying to encourage them to, hey, let's take some money off the table. And from my perspective, I always think I would rather recognize a gain and pay taxes than have the market down in that stock 20% in one day because they missed earnings. And now all of a sudden you just, you had the opportunity to recognize a gain and keep that cash, but now you're in a position where it just evaporated overnight. So how it would work is often we will get a concentrated position. Let's just use Microsoft as an example. Maybe a client funds that account with $25,000 of Microsoft, and then they'll also give us $75,000 in cash. So now we have a $100,000 portfolio. When we build our portfolios, and this differs by direct indexing manager, we'll typically build a portfolio of 150 stocks. So Microsoft that's in the S&P 500. We're likely going to want to own that anyway. We take that cash and we buy 149 other stocks. And what we'll do is systematically look at the portfolio on a quarterly basis, and we'll say, hey, out of those 149 stocks, are there any losses? And if there's a loss, we will recognize the loss. So let's say Coke is down 10%. We'll sell Coke, recognize that loss. We will then take the proceeds from Coke, we'll buy Pepsi. We always want to maintain market exposure. We want to always maintain exposure that looks like the index because that's what we're trying to track. And with that Coke loss, we will now say, hey, let's go to Microsoft. We have a loss. Let's recognize a gain in Microsoft. So for the client, we just were able to diversify. We sold some Microsoft at a gain. The gain is equal to the loss we recognized in Coke. And now they have just de-risked their portfolio through this process. And once this starts happening, over the quarters and over the years, the client's position in that concentrated position will come down because we were able to generate losses elsewhere. Not that we wanted to generate losses. The market gives us volatility. We took the loss, and it allows us to help offset that position. And we were talking earlier, it's always a great time to get these direct indexing accounts open and running. So we talk about this kind of lost harvesting engine. You always want this thing in the background because you never know when the market volatility is going to hit. You don't want to be scrambling to open up an account once the market is volatile. You just want this thing running in the background, recognizing losses when they exist. And sometimes if you're in a bull market, they don't exist. There aren't a lot of opportunities. And so in that case, you end up with a portfolio of 150 stocks that are all at gains, and they go from short-term gain to long-term gain, and clients are in a really good tax position. But using concentrated positions, low basis stock, it really helps the advisor and client kind of get off the starting line and do something about that concentrated position and help de-risk their portfolio.
And what I've explained to clients too is, hey, I could do this myself, but if I did, I would work with maybe 4 clients because I couldn't do that, and honestly serve, so your system and process, to my understanding, is through AI. Correct me if I'm wrong, to where every quarter, that's how, and kind of dating back to your initial answer of the history of direct indexing, you had mentioned technology is integrated, which has made this probably more readily available to, call them retail investors. So what happens on a quarterly basis? Is that done through AI? And what I've just explained to clients is like, if I had to do this, for every single client, and that's why we partner with folks on doing this, is that this process is automated. Talk to me about Natixis's process when it comes to, the buying and selling of securities.
Yeah. So I wouldn't call it AI. I would say, we use an algorithm. It's a multi-factor algorithm. So it's a computer program that we've developed over, the 2 decades we've been doing this, that systematically looks at each account. And we have over 20,000 accounts. All those accounts have 150 stocks. And it's not just 150 stocks. You contribute money to these accounts over time. You add cash to it, and every time you add cash, we're going to buy more shares, and we might be buying 2 shares at a time. So we have these individual tax lots. So just because a stock is down 20% doesn't mean you have a loss in it. You might have 10 different tax lots. You bought one, in January of this year. You bought one in February of last year. You have all these different lots. And that's what we're looking at. We're looking at the tax lots and saying, hey, is there a loss here? And is the loss large enough that we should be trading it? So we have thresholds on when we want to harvest losses. Short-term losses are worth more than long-term losses. So a stock doesn't have to be down as much on a short-term basis for us to want to harvest that. And then once we harvest it, we got to figure out where does that money go, because we want to make sure that we're maintaining our exposure to the same to the sector. So if we sell something in technology, we want to buy something else in technology, but we can't buy that same stock back because of this wash sale. You have to wait 31 days. So now we have to consider the wash sale rule, and then we have to go buy a security that we don't already own in the portfolio to avoid the wash sale. So it's a lot of things to juggle, and that's done on a quarterly basis is how we do trading. Some firms do it daily, some firms do it monthly. But to your point, if you're trying to do this for clients on a systematic basis, it is a lot of work. And frankly, given the cost of direct indexing to clients, and it's more expensive than a index fund or an index ETF, but it's less expensive. than active managers, it's not worth the advisor's time. In my opinion, it's a really great deal for clients to have this done systematically for them. And the other thing is advisors, and I've got a stat that I'll just share quickly. There was this survey that was done by CEG Insights report, and the question or the topic was tax planning. And they asked wealthy investors, how important is tax planning to you? And 89% of investors say, yes, tax planning is important to me. Then they asked the advisor, are you doing tax planning for your investors? And 85% said, yes, we're doing it for our clients. Then they went back to the investors and they said, is your advisor doing tax planning for you? And
I'm curious to hear this. I'm curious to hear this number.
The answer was 25%.
Wow.
Right?
So we're doing it, but we're not actually doing it, is what the numbers say.
Or the clients don't know what you're doing for them. And so, most advisors at the end of the year will do tax loss harvesting. They'll look at a portfolio. Are there any funds that are down? Are there any ETFs that are down? Individual stocks. So a lot of tax loss harvesting tends to happen at the end of the year. But, we're in a year where the S&P is up 15%. There might not be tax loss harvesting, but there was tax loss harvesting opportunities earlier in the year, the first week of August.
100%.
So there are opportunities to sell things when they're down, replace them with another security. And if the markets go up, usually the replacement securities kind of bounce back up. So again, at the end of the year, your performance is going to look like the index, but we've generated losses. And so I'll just give you a for example. In the last 18 years, we have harvested net. So in the last 18 years, when the S&P 500 was up, had a positive year, we had 16 years where we generated a net loss for the client.
Wow. That's amazing.
So
yeah,
the market's up, we're up, but we've generated losses, a net loss from a tax man's perspective for that client.
That's such an interesting statistic, though, from a advisor client standpoint. I'm really glad you shared that, because you're right. It might not be the fact that they aren't doing it, but the client isn't aware that they are doing it. So that's super interesting and super intriguing. Now, one question that I have is, okay, we're doing this, we're harvesting losses. But at some point, if we're not adding dollars, does direct indexing make sense, right? So let's say, we put in either concentrated position, whatever it is, cash, okay?
Yep.
We're accruing losses, and we've been doing it for 3 years, 2 years, but we haven't added, anything to the account. Is there a point in time at a later date where it's like, hey, we're not able to really find opportunities. This strategy no longer makes sense. And that was one of the things that I really dove in on, was like, what's the downside to this? That's what I kept looking for, and that was over glaringly, because I like to get a lot of different opinions, not just from advisors that work for the firm where I am at Raymond James, but other firms, and getting their opinions, and what people are talking about in the industry. And one advisor had mentioned, well, it's just a way for advisors to try to retain clients, because, transferring 150 securities is a nightmare for the client. So I guess my question is there a point in time where it doesn't make sense to implement this strategy because there's no other way to find losses unless we're adding dollars?
Yeah, it's a great point, and that's considered the downside, but I also think it's kind of the thing working. Like, at some point, you're going to end up with a portfolio of stocks that have all appreciated, right? And maybe it's 3 years, maybe it's 5 years, but there comes a point where a lot of the losses have been recognized in the portfolio. And in that scenario, you end up with a portfolio of securities that are all trading at long-term capital gains. And again, long-term capital gains rates are much lower than the client's ordinary income rate. And so now you have this portfolio of 150 stocks. So the question is a client annoyed that they have 150 stocks instead of one line item? Maybe, but they have benefited from years of lost harvesting throughout that process. So as we talk about, how can you keep the lost harvesting engine running, you made the great point there, is if you're systematically adding cash to the portfolio, then you're creating new tax lots, and those new tax lots allow for another loss harvesting cycle to take place. You own the stocks outright, so you can decide to use those appreciated stocks to donate, for example, to a charity that's important to you. They will happily take your security in kind. And when you do that, you get the benefit of the market value of the security. So let's say you donated NVIDIA stock worth $25,000, your cost basis is $5,000. You get a donation value, you can deduct $25,000 from your taxes, as long as you're itemizing and it's like within the 30% of AGI, all that. And you don't have to pay taxes on the $20,000 difference, right? It grew from 5,000 to 25, and you don't have to sell it. You don't have to recognize 20,000 in gains. So that's another opportunity. Clients at some point might decide, you know what, maybe I'll use this to start generating some income. And what they might do is they might sell index call options against the portfolio. So I've got a portfolio that looks like the S&P 500. If I sell some call options, it's a way for me to generate some income on that portfolio. And then there are a couple other strategies that are being looked at, internally, and our competitors are out there offering for kind of longevity. But yeah, in a worst case scenario, you end up with a portfolio that's appreciated. It's gone up like we hope the market will do over the long term, and you got 150 stocks that are all at long-term capital gains.
Do you think that makes total sense? Do you think, let's say a client say, hey, no, this sounds like a great strategy. I think I could use this in the future for tax XYZ. 5 years from now, they haven't added any dollars to the account. At that point, does it make sense to divest into just a standard brokerage account where it's like they're just holding these positions long term, or do you still see the value in the direct index at that point?
Yeah, so we've seen that. At some point, the advisor said, or the client said, why am I paying a fee for this? I think the fees are low enough and attractive enough that it makes sense to have the professional management for when the time comes that there's lost harvesting, and then it becomes a liability for the investor, kind of watching over that portfolio
for sure. And like you said, not to cut you off, but the expense of it is comparable or more cost efficient than some mutual fund strategies. So there's an argument to be made there as well. But I also think, I have it written down, you had mentioned it earlier, in terms of over concentrated positions, like not paying any tax is not a good thing at times, right? Obviously, if you have a highly appreciated stock and you pass away, that's going to go to your beneficiaries. They're going to step up to it. So that's not a big deal. But in the case that somebody, I see this more times than not, is that people have worked at a company a very long time, and a company that provides them an employee stock plan, and they've accumulated, it's done well for a very long time. But I think it takes reminders, things like CrowdStrike, to go, maybe I probably shouldn't have all this in the same area. And not that we ever foresee that happening, but it has happened and could happen. And I know one of the quickest ways to build wealth is an over concentrated position, but at the same point, it's a good way to kill wealth. And so it's, and in terms of in the investment world, we're trying to manage risk, right? So when a client comes to me and has 50% of their portfolio invested in their own company that they're currently with or used to be with, everybody's stomach for that is different. For me, that would keep me up at night for sure.
Yeah.
And especially for folks that, are still working and maybe have 10 plus years at that company. If they obviously stay with that company, it's like, man, they're providing you your salary. They're providing you, the insurance more than likely, your 401k plan, as well as your stock. Like you're investing a lot in one area,
Right.
having, if something were to happen, not saying it is, we just want to manage the risk portion. And that's where I believe that this strategy can make sense for a lot of different folks that have highly concentrated positions that are going, it's done well, don't necessarily want to get rid of it. And they're essentially investing in, whether it be a growth company or a value company, they're in an all equity position. So, hey, don't you think it might make sense for us to peel back some of this and get that position more manageable, where it's maybe 5% of your overall portfolio as compared to 30 to 50%. But that I see that all the time. Hey, stock's done well. I got a 15% discount on it, but why would I sell it? And that's where I think this strategy is so unique.
Yeah, and that's where it comes down to behavioral finance, right? Is trying to
100%.
help clients think about these things, and that's why it's important to have an advisor with an objective opinion on this stuff and help them think through all the cases. But you make a great point, right? So you're talking about two important things. One is the client's financial capital. What do they have in stocks, and how concentrated are they in particular positions? But also the human capital, which is where's their income derived. And so, going through the CFA program, you learn about this stuff. And so you think of a client that has a job, a stable job. Maybe they're a school teacher. You can think of that income stream as like a bond, right? It's not very volatile. So you might say, hey, that school teacher, they don't need to own any more in bonds. Their portfolio should be more stock heavy, as opposed to somebody that might be in the technology business that has a really volatile income and in financial capital tied to their work, and maybe they should own more bonds in their portfolio. But when it comes to direct indexing, what we didn't talk about is the customizations. So if you work for Microsoft, you probably have plenty of Microsoft shares. If you go out and you buy an S&P 500 index fund or ETF, you're going to have 7% in Microsoft in that portfolio. And you can't do anything about it. When you buy the fund, that's what you get because it tracks the index. With direct indexing, you own the account, you own the individual stocks, and it allows for some customization. So you can set up your account and say, buy the S&P 500, but don't buy Microsoft, or buy the S&P 500 and I want to exclude this particular industry within the S&P 500 because I'm in the energy services industry. I don't need to own any more of that. So now you're adding customizations, and it can go into things like business involvement screens. So I don't want anything to do with abortion or contraceptives. I don't want anything to do with animal testing. And so now the client is taking their S&P 500 and they're reducing their investable universe for these personal values or based on other important considerations. So it allows some customizations. And so earlier I said this is mostly a vehicle in taxable accounts, but it can be used in retirement accounts if you add these customizations. You don't get the benefit from tax loss harvesting because it's a non-taxable account. But if you want to own the S&P 500 and exclude companies involved in abortion and contraceptives, then that's a way for you to get the S&P 500.
Interesting. Yeah, I never thought of it that way. Yeah. That's super interesting. The other thing too is I know we've talked a lot about the S&P 500, but clients don't just have to track the S&P 500. They can track any index. Isn't that right, Greg?
Correct. Yeah. We've got probably half a dozen indices that are commonly used. I'd say the S&P 500 is the most
For sure.
popular. The S&P 1500 is the next most popular. I think that's really interesting. So the S&P 1500 is considered an all cap index, but it's really heavily tilted towards the large cap. So it comprises of the 500 large cap stocks, 400 mid cap stocks, and 200 small caps. But in terms of the overall weight of those, the S&P 500, the large caps are like 90%. So you have 10% in small and mid caps, but the small and mid cap stocks offer a little bit more volatility, which can lead to more lost harvesting opportunities. And then it also gives you exposure to what I call lottery ticket type companies. So maybe a biotech company or something like super microcomputer, right? AI focused, that just all of a sudden is up 200% in the year or in the quarter. And what will happen is as those companies grow, they move up into the S&P 500. And so if you had a mid cap S&P 400 only portfolio, once a stock moves up to the 500, they have to sell it because it's no longer part of the index. So with the 1500, it allows those winners to run.
That's pretty cool. How many individual stocks or securities are in that strategy? Because I'd imagine more, or is my assumption wrong?
It's a little bit more. Yeah, it's more like 200 instead of the 150 for the 500 stocks. Yep.
That's very neat. I think the customization is a very unique thing. So hypothetically, whether you're in an industry or not, you can obviously either invest in that industry or not participate, or potentially a client that's more risk adverse could come to me or another advisor and say, hey, this AI thing, I really like it, and I want to track any AI company within the S&P 500 or it has exposure to that. They could do those sorts of things by using the customization. Is that right?
Well, we wouldn't be able to emphasize any more on a particular company. How that would more likely manifest itself is select an index that's more tilted that way. So, for example, like the S&P 500 Growth Index, which is more, technology AI focused.
Sure.
So it's taking kind of the traditional S&P and adding the growth tilt to it, which would manifest in more of those types of companies.
And I think that 2022, for me personally, you talk about diversification, and it's like you can put clients to sleep sometimes because it's like it's boring to talk about. But for folks that were working in tech, I think that 2022 was a pretty eye-opening year for some. Tech got hit over the head, large growth did. And so I think clients and prospective clients, because I feel as though sometimes clients or prospective clients only remember what happened recently.
Yeah.
And 2022 was recent enough to go, that wasn't fun. And I work at a company that is a large growth, and I now see the value in diversification. So sometimes it takes those subtle reminders in the market cycle history to say, this is why we diversify.
Yeah, and that's a great point. So let me just expand on 2022. 2022 was a year when the S&P was down 20+%. If you looked at the average, or if you looked at the 300 large cap blend funds, actively managed mutual funds in the Morningstar universe, 100% of those lost money. Makes sense. Market was down 20%. Everybody lost money. Fine. 83% of those mutual funds paid a capital gain to their investors.
Wow.
So at the end of the year, mutual funds are required to distribute capital gains to investors. We're talking about in direct indexing losses. Mutual funds can't distribute net losses to clients. So we didn't get into this earlier, but that's really the benefit of the direct indexing. When you harvest a loss, it's your loss that you use on a tax return. If a mutual fund loses money in a stock, they can't pass that on to you. So in a year like 2022, what happens is you have a lot of investors hitting the eject button. I'm selling out of this mutual fund. It's down. It's looking like a terrible year. I just want to get out. When the mutual fund portfolio manager gets all these sell orders, they need to raise the cash. When they raise the cash, they're having to sell securities in their portfolio. They're not selling the securities that they just bought that maybe they think is, a discount or has great growth prospects. They're looking to the stocks that they've held for a while, maybe the stocks that are overweight in the portfolio, usually the stocks that have a gain. They're selling those stocks, and so they're generating gains. And if you are an investor at the end of the year, and again, this isn't a taxable account,
Right.
they have to distribute those gains. And so, again, 83% paid a capital gain, even though the client for that year had a net loss position if they invested at the beginning of the year and held it to the end of the year. And so that's a really important distinction on why this direct indexing and harvesting losses when they exist to be able to use to offset future gains is really important. And the tax rules let you use a loss against all your gains in the year. If you have excess losses, you can use $3,000 to offset your ordinary income. So if you make 100,000, you have excess losses, you can reduce that to 97,000 of income. And then those excess losses can be carried forward indefinitely or until the taxpayer passes away. So you have this like bank of losses, and that's another example of how this strategy is used. If you have a future capital gain event in the future, I know I'm going to sell my business in 5 years. I'm going to sell it at a huge gain, huge profit. Or I've got a piece of real estate that I'm going to sell in a few years.
Ding, ding.
I'm getting out of the business. I'm not going to do the 1031 exchange, which is tax-free exchange. I'm just going to recognize that gain. Let me build up of kind of war chest of losses so that when the tax bill comes in 5 years, I can help offset it. And advisors that set these things up, and we talked about it, get this loss harvesting engine running now, they look like a hero to their clients. And they also look like a hero to their clients' CPAs or tax professionals when there's this bank of losses that can help mitigate that expense in the future.
I'm really glad, because that was like one of my remaining questions, was to talk about like kind of who this makes sense for. And one of the biggest ones that I feel as though for folks is, hey, real estate's done okay, I think, the last few years, last time I checked, right?
Yeah.
And let's say they're going to have kids out of the home in the next, call it 5 to 10 years, and they want to downsize. Well, you're going to be probably more than likely, obviously, that you have $500,000 in terms of tax-free, from selling the home. But let's say, shoot, you've been in this house since 80 or whatever that situation is. Maybe it's empty nesters that are wanting to move south to Arizona, and they lived in the Northwest where their homes appreciated. They're from California and their homes appreciated $1 million. Well, if I know that I might sell my home in 5 years, a strategy like this could make a lot of sense, where at the end of the day, we may not be able to completely eliminate the taxes that we pay on a gain on a real estate property, but we could offset a chunk, right? And anything that we can pay less in taxes is obviously a positive thing. And then the other one, business owner, right? You talk about succession plans and, especially for, businesses that have been around a while, and now you have this large group of people that are getting closer to retirement.
Mhm.
and are looking for those opportunities to sell the business, well, there's going to be a huge tax event in the future. So it's like setting yourself up for success for when those events, do come. And that's where I think this strategy is so unique and can make sense for a lot of different situations. And oh, by the way, you're still staying invested throughout this entire time. And you
Yeah.
don't need to use those losses every single year. You can carry them forward infinite amount of years. You could use it in a year it makes sense. You could use it in years way down the line. And that's like the flexibility of it is truly unique as well. But I'm really glad you touched on that, because to me, the real estate piece,
Yeah.
everyone's home in the last 5 years has appreciated so much.
Yeah.
Yeah, we've had a little bit of a slowdown with rates and everything, but if you've been in a home for 10 plus years, you're likely sitting on quite a bit of equity, and there just could be a future tax event. And this is a strategy that, implemented correctly, can make sense for a lot of folks.
Right. And yeah, so let me hit on a couple of things. So one you mentioned is you're invested in the market, and that is the benefit, the most important part of wealth building is to stay invested in the market, right? No matter what's going on politically, geopolitically, volatility wise, interest rate wise, all that stuff. The S&P 500 is just this compounding mechanism for wealth, generating consistently double-digit returns for clients. And consistently, you see these Dalbar studies which say, hey, what's the average client earning when they're invested in a fund that's up 10%? And it's like a fraction of that, 2, 3, 4%. And it's because they're jumping in and out, right? And so the benefit to me of direct indexing is the client is staying invested in the index. And when they want to do something, typically when there's volatility and when the market's down, they typically want their advisor to do something for them. What are you doing for me? And the advisor knows we should just be sitting still, but the client wants to see action. So they can see action in their direct indexing accounts because they have all these 150 stocks that are actively being loss harvested. We're actually doing something beneficial for you when there is volatility. And that gives clients comfort that I'm not just sitting here and watching the portfolio going down. We're actually taking advantage of it. So that's one thing. The other thing, in terms of putting some numbers around it, what we typically say over a market cycle, maybe 3 to 5 years, but again, depending on the volatility, we're generating maybe 20 to 25% of a portfolio's value in losses. So if you have $1 million portfolio funded with cash, we hopefully will be able to generate somewhere between 200,000 and 250,000 in losses. And that's kind of a range given historic market volatility. Obviously, things can change and there's no guarantee. But think of $200,000 to $250,000 in losses banked over call it a 5-year period. So to your point, maybe we can't mitigate all the gains from your home sale. You're going to shield $500,000, as you said, but from what's left over, we've got a bank of 250,000 in losses that we can use to offset. So that's kind of a little bit color around the numbers with respect to the loss harvesting activity.
Awesome. Well, hey, I think that's a really good place we jam-packed a lot of information in there in a short amount of time. I really, really appreciate you taking some time with me today and going over what I feel is a really cool thing. So I appreciate you joining, and hopefully, this was helpful to a handful of people, because ultimately, there's not a ton of people that know about this. And, it is becoming more and more available for, everyday investors. So I really appreciate the time, Greg.
Yeah, my pleasure. Thank you so much for having me, Jason.
Thanks a lot.